Is Constellation Energy a buy or a sell? Let's get started with the model. This is a large cap company, 95 billion market cap. They're trading at 305 a share, and they have 311 million shares outstanding. This company generates and sells electricity. It has 33,000 megawatts of generating capacity, consisting of nuclear, wind, solar, natural gas, and hydroelectric. Its customers are utilities, municipalities, cooperatives, commercial companies, industrial, governmental, and residential. It was incorporated in 2021, headquartered in Baltimore, Maryland. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Every year they have negative free cash flow, and in the trailing 12 months it was negative 7.2 billion. I know the forecast next year is for them to have positive free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a small negative in 21 and 22, then positive 1.6 billion in 2023, almost 3 billion in the trailing 12 months. Pretty good margins. They convert 12% of their revenue into net income. Revenue is a sales for the company, and that went up from 20 billion to 24 billion. And then since 2022, it's been pretty much flat, around 25 billion. They do pay a dividend of 0.46%, almost 1/2 of 1%. With negative free cash flow, that's a really risky thing to do. Hopefully they generate positive free cash flow so they can afford the dividend and possibly raise it. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 99 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $77 billion. We divide that by 311 million shares. And we get a calculated stock price of $248. They're trading at 305, so they're trading at a 23% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. Imagine putting $10,000 into this company when they started trading in January 2022. You would have had an annual return of 92%. Your $10,000 will be close to $70,000 after just 3 years. The stock is up 600% since IPO. To summarize, I have them trading at a 23% premium. It seems pretty overvalued, so ranking 3 out of 10. Short term, 3 out of 10. Because it's gone up so much since IPO, I could see a big pullback soon. Long term, 6 out of 10, because if you hold it for 5+ years, I think it should be okay. Ratio is 4 out of 10. We can't look at their price to free cash flow, negative free cash flow, and all their other ratios are worse than the median. Financials, 2 out of 10, because their free cash flow is negative each year, and revenue is only up 22% since 2021, and it's actually down since 2022. Let's take a look at their income statement. Here's the third quarter of 23, third quarter of 24. Revenue is up a little bit from 6.1 billion to 6.6 billion. Let's see if they give a breakdown of the revenue. Of the 6.6 billion of revenue, 1.6 billion in the region Mid-Atlantic. The Mid-Atlantic includes Delaware, Maryland, New Jersey. It usually includes New York, but they did strip out New York. That's 500 million. It also includes Pennsylvania, DC. Of the 1.6 billion of revenue, most is contract revenue, 1.5 billion. Only 100 million is non-contract. In the Midwest US, 1.3 billion of revenue, 958 million in contracts. Midwest consisted of 3 I's: Illinois, Indiana, and Iowa. A lot of other states in the Midwest: Nebraska, North Dakota, Ohio, Wisconsin. New York, 500 million of revenue, most in contract. In the ERCOT region, that stands for Electric Reliability Council of Texas. About 3/4 of Texas is the ERCOT region. That's 522 million of revenue, 307 million in contracts. And then all other power regions, 1.4 billion of revenue, 1.2 billion in contracts. Natural gas, 500 million of revenue, most is non-contract. And then other revenue, 666 million. Also, most of that is non-contract. They do footnote other, footnote B. This represents activities not allocated to a region. It also includes mark-to-market gains. That's when you mark a derivative, like an interest rate swap. Here's a breakdown with percentages. They're up the most in the Midwest, up 14%. Mid-Atlantic also up around 14%. New York is down, ERCOT is down, and other is down. Electric revenue is up 3%, other revenue is down 8%. So their total revenue is up 7%. Let's go back to the income statement. Below revenues, operating expenses, purchase, power and fuel, $3 billion, operating and maintenance, $1.5 billion, depreciation and amortization, $266 million. Then you have taxes, $165 million. Total operating expenses, $5.1 billion. That gives them operating income of $1.5 billion, up a lot from last year. Last year was below $1 billion, so it's up more than 50%. They spent $147 million of interest on their debt, so their pre-tax income $1.6 billion, $449 million of taxes, so their net income $1.2 billion, which is up a lot from last year of $700 million. They did decrease their shares outstanding. It went down 9 million. Last year, 322 million, now 313 million. So their EPS is up a lot, from 227 to 383. So net income went up and shares went down. That's what you like to see. Let's look at a balance sheet. Their current assets, $9.3 billion. Their current liabilities, $5.5 billion. So current ratio, a little below 2. They have $1.8 billion of cash. Last year was only $368 million. They have $89 million in restricted cash. Restricted cash is cash set aside for a specific purpose, like to acquire a company or maybe to buy a factory. Accounts receivable is $1.2 billion. This is how much money other companies owe them when those companies buy on credit. Other accounts receivable is $557 million. Mark-to-market derivatives, $630 million. They have a good amount of inventory. Natural gas, oil, and emission allowances, $200 million. Below that is materials and supplies, $1.3 billion. Then renewable energy credits, $700 million. Some companies or individuals purchase renewable energy credits. A REC generates 1 megawatt hour of electricity from a renewable energy source. It's a good way to lower your bills by buying these credits. Constellation generates these credits because they make energy. So if you want to reduce your overall carbon footprint, RECs are good to consider. You could generate these credits if you install solar panels or other energy sources. That's what this company does. For an individual to do this, it's expensive. So that's why some people purchase the credits. So a lot of businesses do purchase the credits to power their office. Let's go back to the balance sheet. They have $2.8 billion of other. Let's see if they talk about what this is. I cannot find the breakdown of this, so let's move on. Lots of PP&E, $21 billion. They have $18 billion of nuclear decommissioning trust funds. So before a nuclear power plant begins operation, the NRC, that's a Nuclear Regulatory Commission, this entity requires Constellation to establish a trust fund or a guarantee from its parent company to ensure there will be sufficient money to decommission the facility. Decommission means shut it down, close it. Even though nuclear power plants are safe, historically there's been major problems. In 1979, 3 Mile Island, Chernobyl in 1986, and Fukushima in 2011. A nuclear disaster can lead to many problems. It can lead to people getting sick, people dying, and a host of other things. They have $500 million of investments and only $420 million of goodwill. Goodwill is the premium you pay when you acquire another company. So their total assets, $52 billion. Last year was $51 billion. $39 billion of liabilities. $1 billion of long-term debt due within 1 year. $2.7 billion of accounts payable. This is how much money they owe when they buy on credit. Asset retirement obligations, $12.3 billion. An ARO is associated with the retirement of tangible, long-lived assets. It's mainly for the removal and cleanup of hazardous materials. They're nuclear power plants. They have $13 billion of equity. Equity is assets minus liabilities. They raised $11.4 billion from selling their business, selling stock. They profited $3.3 billion from running their business. Let's look at a statement of cash flows. Here's a trailing 9 months. Operating cash flow, negative $1.4 billion. Last year was negative $2 billion. That's why they have negative free cash flow. They have negative operating cash flow, and they have a lot of CapEx, $1.8 billion. So their free cash flow for the trailing 9 months is negative $3.2 billion. They spend a lot in NTD, non-destructive testing. They invested $5.1 billion. They did receive $4.9 billion of proceeds from NDT. That's a sale of NDT. There was $7.1 billion from the collection of DPP. DPP stands for Deferred Purchase Price. A DPP is when a portion of the purchase price is not paid up front. It's paid later on. It's common to use it in mergers and acquisitions. In their financing section, they paid down $1.1 billion of debt. They also added $900 million of long-term debt. They paid $333 million of dividends, and they bought back $1 billion of stock. Last year, they bought back $750 million of stock. Let's look at a company on Simply Wall Street. Its last price, $305, 76 billion market cap, up 21% in the past week, up 170% in the past year. God, I wish I bought this stock. It IPO'd in January 2022 at $48. That was its low point. It only went up over time. After 6 months of trading, it was at $55, and that was July 2022. It doubled over the next year to around $100 in July 2023, and it more than tripled from that point. It went from $100 in July 2023 to its current peak of $305. Just a few days ago, you could have got it at $244. Here's the reason the stock went up so much this week. They made a $27 billion deal to buy rival energy producer Calpine. They're just gobbling up the competition. This move expands the company's presence in California and Texas, creating the largest clean energy provider in the US. They're number one, and clean energy is on the rise. The reason clean energy is so popular is because of all the demand and power, mainly for data centers to support AI. Simply Wall Street's valuation is $244. They say the stock is 25% overvalued. 15 analysts priced this stock at $279. They also say it's overvalued. The surprising thing is their revenue hasn't gone up that much. It was $16 billion in 2014. Then 8 years later, it was $18 billion. Its peak was $26 billion in 2023. It has come down to $24 billion. Their debt was $8 billion in 2014. It was down to $5 billion in 2022. They added a bunch of debt for acquisitions, $10 billion in 2024, but it's come down to $8.4 billion. Their equity is always higher than their debt. Equity, $13 billion. And their cash is $1.7 billion, which is about 20% of their debt. The CEO's salary is $1.1 million. Total compensation, $15 million. Tenure as CEO, 3 years. 82% of the company is owned by institutions and 17% by the general public. Their biggest shareholders, Capital Research at 12%, Vanguard at 12%, then BlackRock, State Street, Fidelity, UBS at 1%, Eaton Vance at 0.5%, and to round out the list, 59 North Capital. Their employee count in 2014 was 14,000. It's still 14,000. And they're trading on the NASDAQ, Mexican Bolsa, and Deutsche Börse. So if you want to get a copy of my discounted cash flow model, click on the video in the top right corner.